All right, welcome. I'd like to welcome everyone this morning to the SC Launch and Learn with Emmett Moore and John Coffin of Practical Growth Advisors. Today we are discussing the hot topic of valuations and determining the worth of your business. So before we begin, I'd like to go over some really important housekeeping items here. Number one, if you can hear me, please go ahead and raise your hand in the webinar controls. Let's see. Joe, welcome. Cole, Ben, Caroline. We have got a great crew today. Another record-breaking number of attendees. So thank you all for joining in this morning. You can go ahead and raise your hands. I'm sorry, you can go ahead and lower your hands. And secondly, on the format of today's webinar, we're going to keep all of the audio muted for all of the audience. So if you have any questions, please feel free to go ahead and type those into the webinar controls. You'll see the webinar controls over there in your little dashboard. You can type them in at any time, and we will, if a lot of questions kind of build up, we'll kind of pause and we will break for questions. But we will have a dedicated question time right in the middle and then towards the end as well. So you can go ahead and test that out if you would like, and kind of just let us know where you are dialing in from. Just type your city into the questions and we'll be able to see that going. So my name is Julia Linton and I serve as the operations manager for the SC Launch program. And thank you all for joining in today. I'm so excited to have Emmett and John. They work at PGA, CEO and oh gosh, I'm so sorry, John. I'm not sure what your title is. You'll have to introduce yourself. They're a great group. We work with them a lot here at SC Launch, working with our companies. They work in comprehensive real-time monthly reinforcing the forecasting, right, of your company. So I'm gonna hand it over to them. I just want to see what has come in. Let's see, we've got people calling in from Columbia, Greenville, North Augusta. Greetings from Spartanburg. Hello, Augusta. Thank you all for joining in. Emmett and John, welcome. Thank you.
Thank you. It's our honor to be here.
Thanks, Julia.
Can
All
you,
right. There you go. We can see that. Thank you. That's great.
Perfect.
Hi from Columbia. Okay, I'm going to go ahead and mute myself and hand the mic over to y'all. So thank you. We can see you and hear you and view your screen. Great.
Great.
Guys, thank you for inviting us. It's our honor to attend. We've worked with about 4 or 5 of the SCRA and SC Launch companies and have really enjoyed the opportunity to learn about the entrepreneurial spirit of South Carolina. I think this forecast and valuation seminar is near and dear to our heart because that's what we do. Is we really enjoy working with small to medium-sized, high-growth companies and helping them finding ways to, 1, identify barriers to growth, and 2, maximize their value so that they can raise capital and continue to grow, or eventually transition from father to son, daughter to mom to daughter, whatever the family dynamics are, or from entrepreneur to private equity group. And so we really help a lot with companies proactively figuring out what's coming down the pipe and what's going to maximize their value. And to start, there really are 3 methods of thinking about value. And this really works for any asset, but your company is probably the most important one and the most complex. And the simplest is just the cost, how much money's gone into there. And it's probably the least indicative of what the true value is, particularly in post-COVID times, because we all know that the past is not a real good predictor of the future. And I think that kind of is true for the second approach also. When you look at transactions with similar companies, number one, there aren't many similar companies because a public company has really almost no similarity to a company that's starting up, is a new idea, is a family-owned business. Usually those are interesting, and it's kind of the simplest way to talk about value, saying, well, you know, I've heard that my company is going to be worth, you know, 5 times EBITDA or 10 times EBITDA, with EBITDA being really earnings before interest, tax, depreciation, and amortization, which is a complex way to say it's kind of your free cash flow. So a lot of people will talk about value as a multiple of your free cash flow or EBITDA. Once again, that's really looking at the past. And so both of the first two methods, cost and market, are past focused, and past just has very little to do these days with what kind of cash flow you're going to be able to generate in the future. And so we really only focus on one method of valuing companies, and that's proactively getting into the guts of operations, of sales, of accounting, and figuring out what future cash flows are going to look like. And that way you really kind of, you keep your eye on the past, you understand relationships between things, but only with a forecast of the future and forecasting cash flows in the future, you're going to understand what anything's worth, because nothing has value without cash flow. The real value is intrinsic to being able to generate cash. Stocks only have value because they can ultimately pay dividends. Bonds only have value because they can pay cash. Companies only have value because they pay cash. Even the internet bubble and internet valuation of things that lose money only have value because investors see how they can make money in the future. And really, that's how you value cash flows. How far out in the future are you going to get them? The further out, the less they're worth. Everybody would rather have $1,000 today more than they'd like $1,000 in 2 years. Maybe you're indifferent between getting $1,500 in 2 years versus $1,000 today, but you got to get more in the future to be worth the same today. And likewise, the other dimension of cash flow, other than time and amount, are how risky are those future cash flows. And I'm starting in theory, we'll go into practice in just a minute. But understanding a company's cash flows, when they're going to occur, and what the likelihood of those occurrences are, is really the core to valuing a company. Any questions so far? I don't know how to take questions, but.
So far, there are no questions that have hit. But I'd like to encourage everyone on the line to, you know, keep the questions coming as they come in, and then I can ask them as we have these natural breaks. But as of right now, there are no questions, so go right ahead.
So this is very theoretical to start with, but I wanted to lay the groundwork because in practice, it's more of an art than a science, and you find that not only do cash flows they're not like the past. I mean, you can look at accounting data and you say, well, we made $2 million last year. And if you look at the future, you've got to understand that you're looking at a future, and any forecast of the future has a probability. And you're going to find that people look at whatever you put on paper as your pro forma, this is what we're going to do over the next 3 years. They're going to look at it with a certain amount of skepticism, and they're going to have different views on how likely those things are going to occur. And so really your valuation is not just cash flows, their timing and their riskiness. It's also, who are you talking to? Is it a bank? Is it a private equity group? Is it a potential acquirer? Each of those have different views on risk and different understandings of your business. And so, you know, value is never something, if anybody says your company's worth X, you should be skeptical, because there's always going to be a range, and there's always going to be some discussion about who the buyer is, because value is always in the eye of the beholder. And just to give you a quick understanding of that, if you're talking to a bank and you say, we're going to double our size next year, we're going to go from 5 million to 10 million, that scares them to death. To them, you're not worth much because you're a risky investment. Banks do not want that kind of high growth, particularly if you're a manufacturer and are going to have to buy a bunch of inventory and generate a lot of receivables and need a lot of cash. They're going to be much happier with a 10%, 15% growth story. If you're talking to a private equity group, and the reason is they just want their loan paid back. They don't really care if you make more than what you need to pay their loan back. If you're talking to an equity buyer, somebody who wants to invest and own 20% of your company, they love that story. And so you've got to be very cognizant of who you're talking to when you're talking about your company and its value. And maybe you're talking to your employees, setting up next year's budget. Once again, you've got to be very aware of who your audience is and what future you need to be talking about.
A question has come in, and I just want to interrupt you real quick. A question has come in, and I think it's really relevant to a lot of our startups, that we work with. Is I don't know if you're going to address it in the future. So if you are, just let us know, and then we'll sit tight. But the question is, how do you address valuing intellectual property? So, I mean, how do you value that if it's just sitting, in your hand? You've got this certificate. So either address it or we'll talk about it soon.
Well, I mean, I'll address it. In a formal valuation, there are all sorts of ways people try to approach that. But I'll go back to what I said. Nothing has value without cash flows. So if you can show how that IP generates cash in the future, either by licensing it to somebody else or by generating a higher margin than you would otherwise, that's how you show its value. Everything else is kind of just a fiction. I mean, you might have had to pay $250,000 for the IP, but does the buyer really care? No. They care about how much you're going to generate in cash going into the future. And that's why any backward-looking value is an interesting exercise, but it's probably a waste of time. I should have introduced John. John and I are partners. I've spent 30 years in companies being a controller or CFO or COO. Always been an operator, not a consultant. John has 30 years of banking experience and founded and started a bank here in Atlanta called Atlanta Capital Bank. And we really got together 2.5 years ago and realized that my dozens of companies being on the inside and his hundreds of companies being on the outside has given us kind of a unique view of companies and how they can grow in a healthy manner. So that's who we are. And John can answer any of your capital raise and banking questions. And he also is an operator because he had to make payroll just like I did. So I don't know which of us will answer questions, but I'm kind of talking for now. I'm sure he'll come in a minute.
The only other point that I'd make on the IP issue is, if you've actually gotten trademark protection or patent protection, then oftentimes that is something that's valuable, primarily because that's a guarded technology. But to Emmett's point, it's more importantly from a value standpoint because there's some kind of expected cash flow or benefit from that IP. And to the extent that you can have a proven barrier to entry, that's really great, and that will provide some protection to the future cash flow streams. The other thing where, particularly as it relates to trademark issues and IP, that you really start to see the benefit of that is if you have some proven cash flows historically that you can then extrapolate forward with, and again within the context of barriers to entry. So we have worked with a couple of SCRA investment companies who have whether it's the formal or informal IP or barriers to entry, and they very successfully have taken advantage of that because they've got a window of opportunity that they're executing against. And that's really, to us, the key element of things is how quickly can you take advantage of your benefit, and what's going to be the present state and the future state from a cash flow standpoint that's going to help you actually kind of drive value and drive profitability out of your business.
I guess another way to say that is without execution, IP has very little value.
Right.
With execution, even average IP has value. But it doesn't really matter how good the idea is if you don't execute on it. And execution is really only quantifiable by generating some kind of revenue, or cost savings, or whatever the IP is focused on, but it certainly comes out of the flow of cash that it can generate. Let me do a little bit of a pivot now and start talking about forecasting, because that's really what is core to this, and it will link. Did that answer the IP question? Is there any follow-up to that? Sorry.
Questions are flowing in, but there are no more questions specifically about IP, so I'll let you go forward on forecasting, and then we'll skip back and address some of these other questions.
Okay.
Yeah, Julia, that'd be great. Let us get through maybe 2 or 3 more slides. And we'll take a break and then really open it up for questions. But so keep them flowing in, and then we'll make sure that we try to address everything, if that's cool.
We'd really rather focus on your questions in our presentation. So our approach is, we found that every company has at least 3 databases and 3 sources of data. One is focused on the past, their accounting system. Another is their sales system, their CRM. It's focused on the future. And then probably the least well-defined is that number 2, the present data, where you've got employee records, inventory management, backlog, all that stuff on deals that you're working on currently today. And so we've really made it our passion and our mission to integrate these 3 types of data and link them and update them monthly so that companies can reforecast every month. And by integrating these, over time, you can not only predict your income statement, but also your balance sheet. And the balance sheet is what generates cash, because revenue is not necessarily cash. You can't spend revenue. And so it's very important to understand each of your revenue streams, each of your direct costs, how profitable they are, and how much cash comes out of each of those revenue streams at what point in time. We've really integrated the 3 in our IP, which is called Insight, and it's a Excel-based platform that we can take to the cloud, we can take to Access and make a database if we need to, but we find people like Excel. And so we generally go into a company and integrate their past, present, and future data and give them a system that really helps them to make fact-based decisions. And the goal is to increase their value. And so there's a valuation mechanism in the model, so that every month you can look at the value of your company and see if what you did last month increased it or decreased it. I think it's important also to understand there is no one forecast. It's fine to have a budget, but you need to be looking at upside, downside, likely side every month, and really having a plan for each of those possible futures so that you're not surprised, so that you're talking to your banker about, if we close this deal in 9 months, I'm going to need an extra $500,000, or if I get $250,000 in capital, this is what I can do with it. But you've got to be forward looking. If you're focused on what happened in August and it's October, you're gonna run off the cliff. And so
one thing that we really find, we have the opportunity to work with a lot of owners and leadership teams in companies that are multiple different industries. And what we oftentimes find from at an owner level is that they have a very good gut for the business. This is what I think is going to happen. Oftentimes they have a very specific vision on where they want to be in 2 or 3 years, but they don't really have the quantitative backbone or the ability to link what we've done in the history, some of the current learnings that we're experiencing in our present state, and some of the connectedness to future opportunities, how that all links together. And so the forecast mechanism that Emmett's going to describe really kind of helps to take that gut feeling and create a quantitative measure behind it, so that you can assess, is what my gut's telling me a good decision? And so at its most basic tenet, that's what we're doing and helping people work through with their teams. It also enables, as we'll see on the next page, let's see, how do we get there? You typically within an organization have an accounting function, which is the focus is on history, and the owner is typically the person who's running the books, whether it's a CFO or controller or bookkeeper. And the reliability is very strong. It's audited and it's factual. We know what we did last month. Then there's the operating side of things, which is the focus is typically short term. This is presently what we're doing, and the services or products that are in our system right now. And usually that's the owner or the COO or the HR director who owns that kind of information and those databases. And usually, again, there's a factual element to those, but then there's also some opinion that's creeping in. We've got this manufacturing job that we're working through, and we think we're going to get it out the door at the end of the month, but sometimes it might be delayed for 15 days because of X or Y issue. So there's a little bit of opinion in your current state operations. And then obviously on the sales side, these are more long-term views of what the opportunities are. And sometimes those are sales opportunities that are specifically in the works. And then sometimes they are verticals of your business that are less defined, but that still merit analysis because it might be a new product opportunity or a new market that you want to attack. And oftentimes those people, that might again be the owner who kind of bears the brunt of the sales side or a sales executive. And
by the way, that's where your IP gets valued, is you say, with this IP, I've got these 18 customers that I'm going to approach, and I think I can close 3 of them. And I think they'll pay X for my IP. That's where you start to really figure out what it's worth. So you can't really just have a 3 or 12 or even 18-month view. You've got to extend this into 5 years, 3 years to 5 years, even though you know it's wrong, because by definition, every forecast is wrong. It's directionally right. And it starts to kind of lay out a monthly, tactical, step-by-step plan to get from 1 million to 10 million in revenue, or whatever your goal is. And so you kind of have to marry the tactical next 3, 6, 12, 18 months with the strategic, where are we trying to go in 5 years? And you need to do it regularly, at least quarterly.
Yeah, and that's so the added complexity of not only do those 3 systems not oftentimes communicate well with one another, sometimes the leaders of the 3 different areas, accounting, operations, sales, don't always speak the same language. And so
but we also understand that, as you start a company, one person does all these things.
Right.
And then maybe you get a sales team and you're just doing operations and accounting, or maybe you're the salesperson and you hand operations and accounting over to somebody else. So it can be fragmented between 1 to 6 people.
Right. And so this is an issue that every company faces at various levels of their development, whether they're in a startup phase, in an emerging growth phase, or growing into a middle market company where you might have $100+ million of revenue.
I think, just to kind of give you a visual, and we'll stop for questions here because this is much more interesting than bullet points. We take all of the accounting data out of a company. We think it's really important to understand the past, and we'll project all of the easy to project lines like rent or office expense, things that really are going to be kind of like the past. We'll just forecast like the past. But as you move up into sales, particularly for the next 3 to 12 months, you got to look at what's in your backlog. Who are our current clients? What do they spend each month? What are the jobs we have in the pipe that we're buying stuff for? And then we don't take all of that. We just take kind of the biggest, so maybe 80% of it. And then sales, we'll just look at the top deals, the deals that have 90% or so to close, maybe 75%. we can look at the other ones to some degree, but we take less and less of the future data that's not material, and we merge it all into one database, make sure there's a common language that links the 4 or 3 databases. And a good example would be sales has a job they call the Disney job, and they're selling to Disney, and they win it, and it moves into operations and it becomes the Orlando job, and accounting starts to account for it, and it's job 63489. And so you've all of a sudden have no communication because the sales guy comes for his commission on the Disney job and accounting says, what? And that's the first step, is linking all that data through some common key so that you know Disney, Orlando, and 64389 are the same thing. Once you've done that, we forecast, we compare it to actuals. We forecast, we compare it to actuals. We forecast, we compare it to actuals, and every month we get a little bit better at the forecasting. And eventually, after about 3 months, sometimes 4, we've got to where we're pretty good at forecasting by month income statements, balance sheets, and therefore cash flows. And that's what ties back to valuations. Once you can kind of forecast your cash flows and link it back to real data, you all of a sudden have a very persuasive valuation. And it also shows you what are the areas that I can increase my valuation in. What are the ways I can maximize cash flow earlier rather than later?
How can I allocate my investment into the most profitable areas? And that's particularly useful and impactful as a company starts up, where you're doing a lot of experimenting and figuring out what's the best path forward. Julia, with that, maybe we can pause and just answer any questions that folks have. We might stop sharing our screen so that you guys can see us, or can you all see us while we're?
We can't see you.
Yeah, we're kind of presenting blind here because we can't see things. But
that's why I shared my my video so that. Wait, can you guys see me, John and Emmett? Can y'all see me?
Not right now, while we share.
Oh, I understand why you're sharing your screen. Okay,
yeah.
So yeah, maybe you could pause that so that you could kind of.
Got it. Okay, fantastic.
At least we have a
my
person.
face, yeah.
Good.
There you go. I promise there are 50 people on the line waiting for me to stop talking and start asking some questions. Okay, so I'm going to piggyback back to that original question about IP that came in. So Keith has just kind of elaborated a little bit more, and it's also some other questions have come in that's touched on one of his main points. And he says, very specifically, we have been approached by companies trying to buy us for our IP, but it's also for our people. Being primarily an R&D company, we don't throw off a lot of cash flows. So a lot of other people are also asking similar questions. You know, we don't have the cash flows coming in, but we do have leadership, goodwill, competitive advantage, etc. Could you kind of, address that?
Absolutely. That's a great point, and particularly on the technology side, or other types of companies, that's the IP is helpful, and to the extent that you've invested to protect it, that's great. People are extremely useful and valuable, but investors, whether they're looking to acquire your company or invest a minority share in them, will understand that people also walk out the door every night. So there's a situation where you have to kind of be thoughtful about that. And while I think that particularly at an early stage, all of those things are important, it is really important to additionally kind of say what that IP and what those people are actually going to be able to do. And so, we're walking through this with one of the companies that we're working with right now, and it's very early stage. They have 3 or 4 very significant opportunities that relate to B2C situations as well as B2B situations. And the reality is that they're very close to closing 2 or 3 in each of those areas. And so we've taken their expertise, we've taken their IP, and then really translated that into, okay, here are the specific opportunities that we're seeing. This is how they cash flow over a period of time. And oh, by the way, if we do this with one OEM, there are 3 other ones that are likely going to be interested in our services. So you start to build you take the IP and the people, but then you create a building blocks of what that actually translates to from a revenue and cash flow perspective.
And even if you can't generate revenue with the IP, you can work with the buyer and help understand how you're going to impact their revenue and their cost.
That's a great point. Yeah.
But you've got to quantify it more than we spent $500,000 on it, so I want you to pay us $1 million. That's just not going to work.
Julia, are there other IP related questions or things that we can address on that front?
Oh, we can't hear you.
Thank you. There are no other IP questions that have come in, but we do have a variety of other questions. Nicole is asking, is a company worth more if they do more cash receipts or terms?
So is this Nicole from Boyd?
I will leave that to the imagination.
We know Nicole.
And protect her, but I think it's a great question that a lot of people can relate to.
Cash is, I'll say the best way to maximize your value is to get cash in quickly but minimize risk. And so there are times when terms are going to get you the bigger deal. You can't do business with Walmart and get them to prepay. And so it's a balance between credit risk and growing your business. And I think particularly nowadays, things are so uncertain. I think having terms that go past 30 days is really becoming more and more risky. And so they're equal in some ways, cash versus getting the cash in 30 days, whichever, but you're not going to be able to grow without some terms. So I would say to maximize your value, you're going to have to balance that risk of receivables versus getting the cash early. And we find a lot of our construction clients are getting 50% up front and then the rest when they're done. And that kind of balances it pretty well because they're making about a 50% margin. So they know they're covering the cost of the materials. So that's been an elegant solution, is make sure you get paid early to cover your cost. You can kind of get the profit later down the road if that helps you make the sale.
I would say generally too, in a B2B type of scenario, terms are typical, and you're just going to have to kind of manage that. On B2C, obviously, sometimes you want to have that be a tighter leash, so to speak. And if you're dealing directly with consumers, you want to really lean towards cash or prepayment, if possible.
We don't have time on this call, but happy to show a demo at some point to anybody who wants to see it, because what we do is actually drill down to each of those deals in backlog and pipeline, and we say, what is the cash impact of closing this deal? And this is how many times you can grow a company very quickly without raising capital, is understand, if I sell to whoever, Walmart, this is what the cash is going to look like. If I sell to these local retail stores, this is what cash is going to look like. And that's really important to understand, because you can say, and I've said this many times to salespeople, it's where finance and sales can actually cooperate, is go ahead and drop it 3% on the margin, but get them to prepay half of it. And those kind of discussions really help a company grow, not have to raise capital so much, and maximize their value.
That's great. And that point you just made addressed 2 additional questions that are on the table. And the question was specifically, how do you suggest, just increasing your valuation? So I'll let that one go for maybe a part B webinar series and get some other questions out here. Here's a question talking about.
Can I add one part to that?
Oh, yeah, yeah, of course, of course.
We do a lot of, we start the forecast, we look at it, we say, guys, if you'll just do X, Y, and Z, you'll double your valuation. And those things can be as simple as identify all the one-time cost. Maybe you did an ERP implementation. That's not part of operation. Don't put that in your operating costs. Put it down below the line. Or, maybe the owner has some automobile expenses that, they are valid for taxes, but it has nothing to do with operations. And so I think little things like isolating costs that aren't part of operations, pulling them out and showing a picture of real operations can really increase your value. Another thing is, what is that? Going from cash to accrual. Most companies early stage, they book revenue when they get cash. They don't book revenue when they earn revenue. And sometimes the conversion from cash to accrual can dramatically increase your revenue and decrease your costs. So there are a lot of things you can do, a lot of things you should do before you start talking to banks, investors, acquirers. Sorry, that was just, I think, addressing.
No, that was some great additional bullets, so thank you. So a question has come in talking about SaaS-based companies, and just in general, what type of multiples are you seeing SaaS, software as a service-based companies getting these days?
So I'll take a piece of that. One of the things that's really critical on that side is how diverse is your customer base, how much pricing power you have on your services, and what's the duration of your client experience and your churn. So
Recurrence.
or recurrence. And so all of those are elements that the longer you have and the more client density that you have dramatically increases the valuation of the business. This is also a situation where beauty is in the eye of the beholder. Oftentimes SaaS-based companies are more valuable as a strategic investment by an existing player than they might be for a financial investor who doesn't understand the elements as much. So that's another thing to think about. It's really hard to kind of put numbers on that.
On a vague industry group.
Yeah, early stage, oftentimes you can get valuations off of a revenue multiple because sometimes there isn't the profitability there, and you're investing heavily in your technology platform, et cetera. What we find with early stage investors who are interested in SaaS or technology plays is it's very important to get really specific about, this is the point where we're making all these investments today. This is the point where our contribution margin, i.e. our cost, the revenues less our direct costs to go to market, where those are going to break even. And then, where's the break even point as you kind of go forward, in continuing the investment, continuing the growth, but at a bottom line perspective where you get profitable. If you can kind of keep that net profitability in the kind of 2.5 year time frame, that's much more attractive to investors than kind of feeling like, oh my gosh, we're going to put money into this business for 3 or 4 or 5 years without really seeing any kind of profitability. So while hot industries are important, and sometimes you can get some interesting valuation dynamics going based on market activity, always kind of focus too on where are we going to be profitable at what stage in our development from a contribution margin perspective as well as a net margin standpoint.
I mean, if it's a SaaS company that has lots of recurring revenue and is kind of over the 1 million EBITDA mark, maybe it's a 10 to 15 multiple.
Right.
But it depends. I mean, if you've got negative cash flow, negative EBITDA, an EBITDA multiple doesn't make any sense. So, you really have to look at the next 5 years and how you're practically going to generate cash out of that SaaS product. And then you get a real solid valuation. And you divide that by the right number and you get your EBITDA multiple. So it's really, EBITDA multiple is shorthand for you need to do a forecast and figure out what your cash flows are.
Okay, this question came in earlier when we were specifically talking about cash flow, although each topic seems to keep coming back to cash flow. So the question is, startups seem tough to value based on cash flow. Isn't cost to duplicate plus market multiple consistent with VC's current approach?
Many times, because there's just not the resources in a startup to do forecasting. Most of our companies have a solid controller, and that's kind of a caveat, because we really want to teach the companies how to do it. We don't want to do it for them. We'll do it the first month, second month we'll do it together, third month you do it, we'll watch. And that's how we like to do it. So most of our companies are at least large enough to have a controller or a solid bookkeeper. But I don't know, does that answer the question?
We'll find out if he writes back and wants to add on to that. So Joe, if you're tuning in still, please let us know if that answered your question.
Let me answer one more. We do have a startup that's making very little revenue right now, but the revenue they are making proves their product. And we found that if they will close a deal with one OEM and one B2C company, they could be a $25 million company in 5 years. And so we were able to compellingly generate a valuation for that company that investors are now putting money into based on that valuation. They understand they're only going to put a small tranche in first, get the first deal closed. Once the first deal's closed, they believe the valuation. And so we get past the chicken or egg concept by going ahead and saying, if we execute this way over the next 4 months for $250,000, we're worth enough for you to put $1 million in. And so sometimes you got to do that bootstrapping.
Okay, Joe, I see your response. So if you want to type out a little more specifics and maybe give a case study or something, then maybe we'll address that piggyback question. So while that's coming in, we have a question that has come in with an acronym that I am not familiar with. So I'm going to ask the question, then you can educate me on the acronym, and then you can maybe answer the question. So who sets the discount rate for DCF, and what is your current rate?
Do that one.
You got it.
Who sets the DCF and the discount rate? I'll be tried it first. Most private equity groups will at least a 20% internal rate of return, because they figure that only 1 in 3 or so, 1 in 4 of their investments are going to succeed. And that's kind of how they do it. In practice, we're finding we were able to sell one company for about a 12% discount rate. They were a light industrial company. So it's really set by the buyer, and the more they understand, can integrate with, and love your business, the lower the discount rate is going to be, because it's really a measure of risk. And so a strategic buyer is going to have a much lower discount rate than a financial buyer, just by definition. And the fewer the acquisitions a company does, the lower the discount rate, because they put more into it. If they're doing lots and lots, they're just churn and burn on the acquisitions, you tend to have a higher one. I worked with a large public company who regularly used 20%. But it's obviously in the eye of the beholder. The more you can convince a company that your future is certain, the lower the rate will be.
All right, thank you, thank you. So we have 2 other questions that have come in. We have 10 minutes left on the clock, so I'm not, I love the questions, but I do want to honor materials that you prepared. So please let me know if you'd like to go forward with the materials, or touching on some of these questions, or maybe we could do both.
Let's keep going on the questions if you don't mind. And
You can send the
and then,
PowerPoint to people if you want.
yeah, feel free to share the PowerPoint with everyone, and we'd love to follow up with anyone who's interested.
The rest of it's really more kind of some of what we've done, and it was going to be more case studies, but if anybody wants to talk afterwards, we're happy to.
Okay, that sounds good. Thank you. Thank you. Okay, so this question is talking about a lot of our client companies that we work with here at Launch. Let's see, many companies that have difficulty valuing their company when raising money. What are your thoughts on valuing early stage companies, or do you see often convertible notes which push the valuation down to a larger round when the company is further down the path?
Yeah, so that's a great comment. And, just big picture, there's stages, right? Early on, it's typically the founder or owner coming out of her or his own pocket, to start the company. Then you get into the friends and family type of scenario, and oftentimes that gets exhausted, but you've been able to, raise some additional capital to get going. Really at the point where you're beginning to look into either a venture capital type of scenario or a private equity group or high net worth individuals who are looking for higher return or higher beta in their investment categories, that's when you really start to kind of move into what we would call the institutionalized world of investing. And you start getting in it goes from, hey, I've got this great idea, I've got a few people that are backing me, and we've got this great thing, to some of the foundational elements that we've been talking about. What's your product all about? How do you execute on your product or services? What foundation, both from an operating and a financial standpoint, do you have in place? These are all building blocks that people are really going to start paying attention to as you kind of move into institutional world. And it's very important to kind of have answers or have them thought out. So you also kind of, this is kind of where we find people not being successful in their capital raises, is when it's a lot of ideas and there really isn't any quantitative backup, because you're the visionary, and oftentimes the people who are providing the money are the quantitative people. And so you kind of have to speak their language to a certain extent, while at the same time, communicating your vision. And so that's where you kind of connect in between strategic aspirations and execution and really getting things done. And the folks that we've either raised capital for or seem to be very successful through the SCRA process are the ones that can both, kind of talk through the big picture market and analytics, and here's what the opportunity is, but then also drive that down to a plan that can be executed on over the next 12 to 18 months.
But and shorter answer, we do see that a lot. People kick the can down on valuation until a professional comes in and say this round will be 80% of round A. Yeah, that's pretty common.
Yeah, those notes are very common.
And by the way, that I ran some scenarios for the Atlanta Technology Group, and almost every scenario that worked out to the benefit of the entrepreneur.
And really what you're saying is we're not ready to put a stake in the ground from a valuation perspective. And you can't find a lead investor, to do that. And so it's a good way to get a wider variety of investors involved earlier, because you haven't answered the key question yet, which is what's the value of the company.
But you probably should still have a forecast in place so you know what you're giving up.
That's right.
In your head.
That's great advice. I appreciate that, and we hear that a lot, with our companies. Another great question. Can you comment or give tips on how a business owner can go about deciding when the planets are aligned for optimizing valuation?
You got to have a forecast. I hate to be a broken record, but I mean, we can actually say, as soon as this deal closes, you need to execute for 3 months, and then you've optimized your valuation. And we did this last year for a company. We worked with them for 12 months. We sold them in November of 19, and it was just magic. They were at the highest EBITDA level ever, and we were able to kind of convert them from cash to accrual. And we acted a little bit as COO and kind of cracked the whip at the end of each month for 3 months, and we helped them minimize their working capital and all the things they needed to do to maximize their value. And they ended up selling for about 130% of the high end of the range they expected. So we were very pleased with that result. But it took maniacally looking at a forecast every month and seeing where we messed up and fixing it.
But the other thing I just mentioned is, I think there's sometimes a view with entrepreneurs or owners that there's only one time to sell your business, and or that the planets are going to align. I think if you kind of break value creation down into specific chunks, okay, we're going to run at this new product launch, and this is what success means there. Oftentimes you're going to, by doing that and executing that, you're going to create the next hurdle of value. And if you kind of successfully move into a new geography, that can create a new layer of client density or valuation. So I would encourage people to think less about a specific point in time, but as you think about what your vision for the business is over the next 5 years, what are those kind of walls of value that you're creating, and how can you accelerate that forward so that at any point your company's valuable, in a situation where you might want to exit or you might want to find an investor.
And those value points are critical to understand not just what they are, but where they are and how much cash it takes to get there. So, should you raise $1 million, 500,000, 2 million? You need to raise enough money to comfortably get to the next value point.
Right. Yeah, the place where we see people get stranded is when they've only raised enough capital to, they kind of run out of gas right at the end of the race, and that's obviously something that we try to, again, through forecasting and really kind of getting everybody understanding the numbers along the journey, that we try to avoid.
And last thing, just as a tangent, right now with COVID, seasonality's been broken, normal patterns have been broken, and so people are struggling trying to look at the past and predict the future. That's why it's so important to really have a good, solid understanding of your pipeline and what deals can close. And you're going to almost have to have 12 months after COVID settles down and finally there's some kind of vaccine or to really get the value out of your company. It's going to be hard unless for some reason you're selling something that's really needed during COVID. It's hard for a restaurant business or something to get any value until they have a little bit more stability for at least 6 to 12 months.
That's great. That literally just addressed one question on the table. So I'm just going to skip, and maybe this could be one of our last formal questions. Do you work with either the lean startup business model or business model canvas for forecasting tools, or by chance have you heard of the blue ocean strategy?
Heard of all of those, but we have found that they don't pay us to say it. The best we've ever found is called Traction, Traction. I'll go get a copy and show it to you. But it integrates everything that we've read in Good to Great, Blue Ocean Strategy, Business Canvas, and puts it in a very tactical way that you can execute against. It's called the EOS, Entrepreneurial Operating System.
Yeah.
The one thing it kind of lacks is the quantitative backbone, and that's why it works well with what we do, because we actually use our model to help measure how you're doing in the EOS system. But I'll go get a copy while y'all are talking.
Yeah, we've found that that's a great thought process for how you scale businesses, and it's very useful not only from a product and service perspective, but also from a staffing and financial development standpoint. So that's a resource that we would highly encourage people to focus on. There's also, I think, another element of things that for early stage companies, they oftentimes get very focused on what's the vision for our business. Thanks, Emmett. And what we vision and strategy is very important, but execution is really critical, and that's the area where we find that traction has been great.
Aligning your people.
Aligning your
so
people.
that they all understand in a very visceral way what your vision is.
Yeah, and this is an area where agile development, kind of comes into play if you're doing some software and tech related stuff, or MVP type of analysis.
So let me give a quick example. We had a company that was doing 30 million in revenue, and they sold toilets, and they sold more toilets online than anyone in the world, and they were making no money. And so when I did the valuation of them, they were worth zero, and they were so angry because they wanted to be worth 60 million or 90 million. And we went through their strategy, we got them on traction, we got a forecast going, and we realized that the only way they were going to have value is to have recurring revenue. And so we started mining all of their buyers to find the contractors. And we started building a contractor database that was a second class of buyer. And they got better margins, but they were able to generate eventually a list of 20,000 contractors. And that became super valuable. And they were able to sell the company in the range they wanted. And it took them about 3 years. And so that's what happens when you figure out what generates value in your company and you focus on that. And
execute maniacally against
and
it.
On execution, this is the other book that we use a lot, 4 Disciplines of Execution. Both of these are very practical.
Yeah. But I think both of your all the attendees would find both of those to be universally relevant to building and scaling companies.
You guys, this has been an amazing session. I personally have gotten a lot out of it that, I just did not know. You taught me the acronym. You taught me so much more.
DCF is discounted cash flow. We forgot to say that. Sorry.
Yes, I put it together. I put it together because you did not technically say that. So thank you. That's awesome. All right. So I just want to end this here because we are right at our hour mark. We've gone over just a couple minutes, but we got started a couple minutes late. There are just a couple additional questions that I will connect the person who asked the question to you guys separately. And again, this will be, downloaded. This recording will be downloaded and then uploaded onto the SCRA website. In addition, I will send this presentation to everybody on the line. I want to thank both John and Emmett for your time today. This has been so fruitful. I know everyone on the line really appreciates all of your time. And I just want to say thank you.
Pleasure.
Thank you very much. It was great being with you all. And if when Julia sends you that information, if you have questions, feel free to reach out to us in any way. Thank you.
Great. Thank you both. And thank you all on the line. I'll see you again. Bye-bye.